Hello everybody and welcome to Breaking the Mould. I'm Clara Hermit and joining us today, as always, we have Russ Mould, our Investment Research Director. Russ, it's another week.
It is.
What's the fuss?
Right, next fortnight, the fuss is all about mining companies. Still very heavily traded by all retail investors out there, even though, truth be told, they've been absolute horrors for the last 3 years. Generally at the bottom of the sector rankings, mining and industrial metals. In fact, they've actually gone down over the last 3 years when the market's actually done really rather well. So it'll be very, very instructive. The next fortnight, we've got numbers from Glencore Xstrata, Ferrexpo, Fresnillo, Antofagasta and Fenner.
If their share prices are suggesting that they're in a hole,
Good.
How are they going to dig themselves out?
So good this time, aren't you? Okay, very simply, they've got a new master plan is the basic premise. If you look at the way the mining companies performed in the previous decade when everything was going brilliantly, it was all about growth, it was all about capital expenditure, it was all about new projects, it was all about acquisitions. That's all changed. If you look at what the majors are doing now, BHP Billiton, Rio Tinto and Anglo American, it's all about capex down, costs down, cash flow up, dividend up, touch wood. So it's it's almost an era of austerity for mining companies, dare one say. Now most analysts aren't very bullish on metal prices for 2014, largely because the global economy is not expected to grow that quickly. So it's very much a self-help program. So using that little checklist, capex, cash flow, dividends and costs, look at all of these numbers when they come out. So you've got Fresnillo and Glencore on the 11th, Antofagasta on the 12th, Ferrexpo on the 13th.
Okay, and you mentioned Fenner as well.
I did. Now, Fenner is a slightly different type of company. You've basically got, I mean, if you look at those miners, they're all slightly different. Fresnillo's big in silver, Ferrexpo's big in iron ore, Glencore Xstrata's big in virtually everything, including coal and oil, and ANTO's is big in copper. Fenner is actually a mining capex play, or perceived as such, because it makes polymer solutions, as they say, which is conveyor belts to me and you, and very, very good at it they are too. Roughly a third of their business comes from supplying equipment to coal and metal mining companies.
Given what you said earlier about spending cuts, we shouldn't be getting too carried away, should we?
Oh, very good. No,
Carried
away, yeah.
Conveyor belts, carried away.
And a brilliant deduction as well, Holmes, may I say, except for the fact the share price has gone up like a rocket. So it's actually ignored all of that. It's very near its all-time high of £4.80. Why? Well, I guess the market's partly saying, know all about the mining capex, don't bored with that, move on. Also, it's got a very good engineering business that is a big chunk, which is going extremely well. And it's got a huge installed base of polymer solutions that need regular service, maintenance, spare parts and kit, which is extremely valuable. So it's a really good company. They report an interim statement on the 11th of March. Their January statement was a bit downbeat. Very limited visibility in the coal industry, as I suppose there would be down a mine, and also sterling hurting the translation of earnings from overseas back to the UK. But overall, for the full year, market's looking for sales down 1%, earnings down 1%, dividend up 7%. So let's see how the interim statement sort of fits in with that.
Is that enough digging for 1 week?
Not if you're Dalton Phillips, the Chief Executive Officer of Morrison, big supermarket chain in quite a bit of bother. Full year results on March the 13th, and the shares are at their lowest level since 2009.
Ouch, what's gone wrong?
Okay, they've been a little bit slow off the mark in the online game, and also in terms of convenience stores, which have been very good for all of the big chains. Again, they've been a bit off the pace. They're looking to deal with both of those now, give him credit. Online, they've done a big tie-up with OCADO, and convenience, they're looking to roll out from 85 stores to 200 in the next 12 months. So there's definitely effort being made. The problem is that the January Christmas statement was a bit of a horror. Sales down 1.9%, like-for-likes down 5.6%. So they really need to be showing that they can do something about that. And again, say, look, online's coming around, convenience is coming around, but the pressure's on, so we'll see what those numbers bring.
Let's check out that one then.
Boom, boom.
What else is going on?
Okay, very quick last thing. Bank of England, 6th of March, latest monetary policy statement. Mark Carney's had a wonderful month with his forward guidance, move backwards, sideways, upwards, downwards. Bit of a policy hokey-cokey. Not expecting anything enormous from the next statement. Unchanged interest rates, unchanged quantitative easing. Market doesn't think there'll be any alteration in policy till after the May 15 general election, although the bond market's getting a little bit nervous because the UK economy does seem to be going rather well at the moment.
Okay, Russell, thank you
Pleasure,
very much.
thank you.
Hopefully that's given you lots to think about and lots to mull over. This has been Breaking the Mould. We'll be back with you in 2 weeks' time with a whole lot more information for you. Until then, goodbye.